Even the number of folios over there have now touched 32 lakhs, which led to the increasing investors' interest in these funds. These are solution-oriented funds that come in, especially for your kids. Now, in that also, they highlighted top-performing funds as well, such as the SBI Magnum Children's Funds Benefit Fund. We had the ICICI Pru Children's Fund as well, HDFC's Children's Funds as well. These are some of the names I mentioned. Other than that, you can see it on the screens for you all as well. When you look at these funds, the average CAGR that one has seen over a period of 3 to 5 years for these funds is in the range of 20 to 30%. Now, to put things into perspective, we have Prableen Bajpai, who is the founder at FinFix Research and Analytics, to talk to us about this. Prableen, good afternoon, and firstly, festive greetings to you. Earlier, we are still ahead of Christmas Eve, but nonetheless, festive greetings to you and your team and family as well. This is something very interesting because through this year in 2025, we've spoken about children's mutual funds, the importance there as well. Now, clearly the numbers also show, right, that children's mutual fund is something that is gaining pace. Are these special mutual funds, where we are seeing such a sharp surge, how should one actually start looking at this, the best ones to spot? Given that, obviously, specifically for children's mutual fund, there's obviously going to be the cost of inflation that comes in as well. How should one go about it? To recap on that front, how should one be looking at these funds?
Hi, Vinny, and festive greetings to you and your team as well as your viewers. These are children funds, Vinny, and let's start from the top. So it's basically mutual funds as a industry, all the different schemes are categorized into flexi caps. So we have different categories. Then we have the large caps. And like that, we have a different category, which is called the solution-oriented funds, within which we have two subsets. One is the children's funds and one is the retirement funds. So we're going to touch upon the children's funds. So within these children's funds, like you mentioned, Vinny, there has been a rise in the AUM over the last 5 years, although the number of schemes hasn't risen that much. So the AUM stood at roughly 9,800 odd crores in November 2020. And as of this November 2025, it's now at roughly 26,000 crores, which is, of course, a high rise in terms of the percentage, which is about 160%. The number of schemes at that time was roughly 10, and now it's up to 12. So in terms of, if we compare as the kind of NFOs we've seen industry-wise, based on that, I would say that the number of entry has been very, very thin in this segment. Only two new entrants which have a life of less than 5 years. So in the last 5 years, there are only two new schemes actually, Vinny, which have been launched. So I feel as a category, it definitely calls for more attention, which it hasn't got, because I think it is an interesting segment which comes with this name especially attached to it. So there is a connection which the investor can make, and there can be a clear understanding as to for which goal the person is investing. Currently, 78% of the overall AUM, which is about 26,000 crores, is actually into three schemes, which are the bigger players. And the oldest scheme is roughly 13 years old, and the newest being about 1 year old. So that's how this category is placed. Now, moving into, Vinny, your question as to how can one start off and look at these schemes. So these schemes come with a lock-in period. So it's an open-ended mutual fund scheme wherein you can invest anytime. But once you invest, then there is a lock-in of 5 years or till the time the child attains 18 years of age or majority, that's called. So let's say your child is 14 years today. So you can you invest, so you can redeem your money when the child is 18. So for you, the lock-in will be roughly 4 years. But let's say the child is 4 years old today, and then you invest. That means for the next 14 years, the money stays there because, after 5 years, you can redeem the money. So from 4 years, the minimum time period that you have to keep it is till the time the child is 9 years old. 5 years is earlier because if you want, you can also keep the money, continue to remain invested there till the time you require the money at the time of college education. The nomenclature and the way the structuring is done within the category, Vinny, that all these different 12 schemes have a different way of investing. So some of them are structured like a flexi cap, some of them are structured like an aggressive hybrid, So some mimic in hybrid category, some of them, track the flexi cap kind of a structure. And within this 12 schemes, in fact, two fund houses like SBI, UTI have two variations for their schemes. So it's a very heterogeneous space. And I think when one starts to look, you actually need to just dive a bit deeper and check what is the structure of the fund. And, then based on your suitability time horizon, one can invest.
Okay, Prableen, thanks so much for, breaking it down for us. It's important for a viewer to understand time and again, because we keep getting these queries of how to go about it, even though we've covered it before. But Prableen, there's a point that you mentioned which I found interesting. When you look at the AUM, that's seen a sharp increase, right, in the 5 years, or in terms of the folios, that's seen an increase, and interest is increasing for these funds from investors' point of view. But why are there no new funds that have come in, and there are only, I approximately believe, 12 funds which are there for Children's Mutual Fund? Is there any reason why we are not seeing more fund launches or NFOs on this front?
Yeah, actually, that's very interesting, Winnie, because like last 5 years, only 2 new schemes have been launched. So perhaps I think because these funds somewhere are also restrictive in nature. Once you invest, you are there for 5 years, which perhaps mutual fund investors are spoiled for, they're spoiled for choice. They want to try out different things. They want to have different funds in the portfolio. So that can be one reason. The second being that there is no standard structure, Vinny, which is followed here. So once you're investing, the investor will have to, have a very specific knowledge of the fund, that how is that particular fund investing. Like you mentioned, returns have been really good for these schemes, and there is no doubt about it. But at the same time, if you're looking at a 5-year CAGR, the difference in the returns is also very varied, because then you have funds which are debt oriented, and then you have funds which are very equity oriented. So, it's a 10% to 30% kind of a variation in returns that we see. So I think some of these reasons sort of restrict their usability. And that's probably the reason that we haven't seen too many funds coming into this space. So I think this is also one space probably underutilized by the industry as such. And I feel insurance in comparison has been launching so many of these children bundled products with investment in insurance. So I think definitely the industry has to rework on the structure, make it better, more interesting and easier for investors to understand. And I think it can be great space for parents to invest for their kids with the kind of clarity that the name itself presents. So I think definitely it should come in more formats, the overall funds.
Absolutely hoping for that, because it's an interesting one. But, this category's return, like you also just mentioned right now, last 5 years, we've seen 21% return. But how does it compare to maybe traditional savings on the long term? Because in 1 year basis, some of the funds have not done that well versus maybe the traditional saving methods that we have. Or how should we compare it with the options like you were mentioning on the insurance side that are there as for a parent to invest as well? So how should we be viewing these funds versus all these other saving methods?
So I think first let's take up insurance, Vinny. So insurance, I think, should be a no-no when it comes to mixing the two things. You should either have a term plan or a health cover or a very clear insurance for the specific reason that you're taking it for, because the role of insurance is providing risk management. And when you're looking at investment, I think then it should be a pure investment product where you have clarity. This is the amount you're investing today, and this is the future value you would get. And also you need I think, clarity in terms of what returns you would be getting, at what time horizon, you can redeem. And there should be no rigidity in terms of pressure on the parents also to invest, because with insurance, once you pay one premium and then you're bound by that for the next 5 years, for example, in a ULIP. But coming, I think, to the more important comparison, because India as a household, if we see, we still have very low allocation towards asset allocation wise, the percentage going into equity from every household is still very limited. While education inflation is very high in India now, it's considered at roughly 10 to 12%. So fixed income, especially FDs, would be a very difficult product in that sense, because when you're looking at taxation and when you're looking at inflation, the real returns actually come out very less. So if you're a person in a high tax slab, and even if your FD is giving you 7%, post-tax, you're only earning 4.9%. And when you're looking at combating 10 10 to 12% inflation, which also means that almost 6-7 years, every 6-7 years, the education cost is doubling, Vinny. So I think fixed income definitely cannot be the only way that you're investing for your long-term goals, especially education. And that is where equity comes in. So equity and fixed income, two different asset classes. Of course, equity is for the long term. So you have to have that horizon of 5 years and plus to invest in equity. But return wise, Vinny, what we've seen that equity definitely hands down beats any fixed income product post tax as well. And that is the only vehicle which can help us get returns which can beat the kind of inflation that we've seen in the education space. And definitely, if you're comparing 1 year returns, then there are so many of the schemes which are giving 2 or 3% returns. So that's not the right way to go about it. So it has to be 5 years and above, definitely.
Absolutely. Long term obviously is the way to compare, but that's a clarification coming in for our viewers, because every time people just see the last 1 year return and then decide on what to invest in, that's not the way to go about it. This is just for our understanding purpose. 5 years, 3 years, 5 years, long term is always the better way to look at any fund, not only children's fund. But on that note, we are going to actually slip into a very short break. We'll come back after the break and keep this conversation going with Prableen as well. Welcome back to MF Corner on CNBC TV18. We are discussing the increase in the interest for Children's Mutual Fund in 2025 and how it's been. And for that discussion, we still have with us Prableen Bajpai. Prableen, while we've spoken about how one should go about it, where is it that one could look to invest here as well, versus the comparison in terms of insurance as well as traditional savings. But there's a lock-in that comes in, right, during these children mutual fund, 5-year lock-in period or until the age of 18. One, do you think this is very beneficial in terms of parents who are looking as a discipline that is created because of this? And also, given that you've seen such good growth already, what ICRA's report also suggesting that this solution-oriented funds, specifically children's mutual fund, will continue to see this 10 to 18% growth in the next few years. How do you see this potential of this category grow in the next few years as well?
Right. I think here the lock-in is a benefit, Vinny, for investors who have put their money, because I think definitely inculcates the discipline, which is sometimes not there when we are investing in mutual funds. Mutual funds being a wonderful product, I think the good part that they offer too much flexibility at times also doesn't work in its favor, because people want to just keep redeeming and tend to chase returns or schemes, which are doing better. So I think definitely inculcates discipline, which is really required for goals which are long-term, such as education. So I think that's one point. Second, that it also helps investors stay put through the different market periods. So times of volatility, correction, and then recovery. So I think overall returns can be better if you're actually staying invested for this 5-year period. That's sort of a basic time that we feel is necessary for an equity investor. So in terms of the time period, I think that's a benefit for these funds. In terms of its potential for the future, definitely, Vinny, I think Indian markets, Indian economy, the stage at which we are, definitely holds a lot of potential. I will not comment on the next 2 or 3 years. Maybe, given the way markets have been, it would be wrong to say that, markets will be giving fantastic returns just in 2 years' times. But definitely, all these investments, whenever we do equities for the long term, and I think India as a growth story is fantastic. And there is a high potential for all equity investments through mutual funds which are done. I think we have excellent fund managers in the industry. And we definitely look at double-digit returns overall for the industry.
Absolutely. But also, probably, there are times during this year when we've had conversations. Some of the views do come in that, you could also go in for a flexi cap fund or a multi-cap fund or some hybrid form of fund and keep investing consistently if you do have the discipline. So for a parent who's looking at this, how should one be looking to blend this equity exposure, debt exposure that comes in, or children's mutual fund? How should one go about this whole process? Is it beneficial maybe to just look at individual mutual funds? Or would you say for a goal-oriented specifically, then you should just look at children fund if you're looking for that goal?
Right. So, Vinny, I'll just give a quick example here. Let's say if your child is 3 years old today, and if you're looking at 10 years of yearly expense as on date for college, so it's about 40 lakhs for 4-year course. After 15 years, the same amount becomes 1.67 crores. And for that, if you're looking at 12% returns overall for any mutual fund you're investing in, then you are looking at an investment of 35,000 a month. Now, of course, I think it's a very logical question that, of course, you can invest through other investments as well. And I think that is definitely an option that would give a more variety to investors. Like I said, that probably one of the demerits of solution-oriented funds, these plans, is that we don't have too much variety, very just few schemes which are available. So I think one way to tackle the problem of discipline can be that you have the investments in your child's name. You can always have an account opened in the name of the child and have a parallel portfolio created where it can be a combination of some index funds and some active funds for the long term, and invest accordingly. And definitely even government schemes like Sukanya Samriddhi or the PPF, Public Provident Fund, can be added. But with the kind of limited resources I think Indian households have, every time we are adding more of fixed income or more of, these products which are slightly lower in terms of returns, the ask for investing goes up. So for the same goal, if you're doing a pure mutual fund portfolio, 35,000 needs to be invested. If you're doing it with Sukanya Samriddhi, then along with Sukanya Samriddhi, you are doing 30,000, which means 42,500 per month. And if you're doing Parag, if you're doing PPF, then you'll have to do about 39,000 overall per month, with 26,500 in SIPs and remaining in PPF. That is because even Sukanya Samriddhi at 18, you can only redeem 50% of the money. And of course, PPF can be redeemed. So just giving an example of how more investments will need to be done, the lower the risk you want to take and go towards fixed income.
Okay. And a quick one, Prableen. There are obviously just 12 funds here. And in that, the top 5 performers that are mentioned are SBI's Magnum Children's Fund, ICICI Pru's Fund is there, HDFC's Fund, Tata Children's Fund and UTI. Which is the top pick for you amongst this?
I would go with names, Vinny, I think, which have a track record, so longer time periods, and I think have seen some markets. But I think SBI, the investment plan has proved itself. HDFC has been quite a consistent performer, and I think even ICICI can be looked at. Again, UTI has two options, so the equity option can be taken, but will ultimately depend on the suitability of the investor. And, they have to deep dive, just look at the portfolio once before investing.
Absolutely, Prableen. Thank you so much for joining us on the show and, helping us understand Children Mutual Fund, what we should be expecting going forward as well. Thanks so much for that, Prableen, for this conversation.
Thank you, my pleasure.
But with that, let's move to our segment of MF news. That's the mutual fund news that has happened during the last 1 week. The first news flow that we have during this week was the NCDEX has received an in-principle approval from SEBI to launch mutual fund transaction platform. Now, this is aimed to expand the financial inclusion and paving the way for its equity as well as equity derivative segment. So an important update that's come in there. The platform is actually going to be enabling micro SIP channels, rural savings into regulated avenues that come in there and support existing trading members. The move is something that is aligned with regulatory intent to deepen the equity segment. And do not forget, in August only, NCDEX had secured preliminary approval to introduce trading in equity-linked products, including derivatives. In November, NCDEX secured the board approval for launch of an electronic platform for mutual fund distribution as well. So this is one more update that has come in here. Now, let's move on to some news flow that's come in on the NFO fund and the new launches that have come in just in the last couple of weeks. First one is the Kotak Mutual Fund has announced Kotak Nifty Next 50 ETF. It's an ETF fund that's come in. It's open for subscription from 18th of December and will close on 1st of January. Obviously, the benchmark is against the Next Nifty 50 index. The other one that has launched on NFO is the DSP Mutual Fund. Two passive offerings that have been launched. DSP Nifty 500 Index Fund and DSP Nifty Next 50 ETF as well. Both of these have opened for subscription and will close on 30th of December. The third NFO that has been launched is by Tata AIA. They've launched the Multi-Cap Opportunities Fund, pension fund via ULIPs, and this is offering a diverse equity exposure linked to Nifty 500. The new fund offer is open for from 24th of December to 31st of December. So these are all the NFOs that have come in and the important news flows around the mutual fund industry. So that is what we have for you all in today's edition of Mutual Fund Corner. Thank you so much for tuning in. Merry Christmas to all of you all as well. We'll see you all next week for Mutual Fund Corner. But don't go anywhere. You still 1 hour of trade that is still left, and Closing Bell is up next to take you through all of that.